Investment Monitor, 26 January 2023, China's dependence on subjugated Africa is only likely to grow. China already invests more than $4 billion annually in Africa, and this amount is expected to rise as China establishes new companies that cater to the African market, putting Africa in a dire debt trap. Africa's dependence on Chinese commerce and investment will likely worsen over the next few years because China offers many affordable manufactured items that Africans need and because Chinese foreign investment has fewer restrictions than Western investment. According to the Statistical Bulletin of China's outward foreign direct investment, annual flows of Chinese FDI into Africa have increased dramatically since 2003, rising from a meager $74.8 million (507.44 million yuan) in 2003 to $5.4 billion in 2018. From $490 million in 2003 to $43.4 billion in 2020, China's FDI stock in Africa more than tripled, reaching a peak of $46.1 billion in 2018. Despite the COVID-19 pandemic, inflows to Africa increased once again to $4.2 billion in 2020 after falling to $2.7 billion in 2019. 63% of the total Chinese FDI stock in Africa was held by the top 10 recipient nations, which included South Africa and the Democratic Republic of the Congo, DRC. China pledged $10 billion in private FDI to Africa over the following 3 years in November 2021 at the Forum on China-Africa Cooperation in Dakar, Senegal. As of today, China is the continent of Africa's most significant trading partner, with $282 billion in trade expected in 2022. Additionally, 16% of all manufacturing imports into Africa in 2018 came from this country, making it the primary source of origin. In 16 African nations, China has established 25 economic and trade cooperation zones. According to the China-Africa Economic and Trade Relationship Annual Report 2021, the zones, based with China's Ministry of Commerce, had attracted 623 enterprises with a combined investment of $7.35 billion by the end of 2020. China's economic and trade cooperation zones with other countries support local industrialization in several stories, including agriculture, manufacturing, marketing, logistics, and natural resources. There are numerous sectors of the African economy where Chinese businesses are active. According to McKinsey, Chinese enterprises already handle 12% of Africa's industrial production in the manufacturing industry, valued at about $500 billion annually. Nearly a third work in manufacturing, a quarter provide services, and around a fifth are engaged in trade and building/real estate. Chinese businesses dominate infrastructure, accounting for nearly 50% of Africa's foreign construction sector. According to Dr. Shirley Zhu, director of the London School of Economics China-Africa Initiative, the objectives for Chinese investments in Africa are entirely hegemonic under the appearance of utilitarian and egalitarian. The security of natural resources is the most critical factor. Resources are unavoidably abundant in the African nations that have received the most significant proportion of Chinese outbound investments. However, resource-poor countries receive more Chinese investments than is proportionate when comparing their GDP to the continent of Africa on a relative basis. This suggests that Chinese investments have strategic goals beyond purely financial ones. Contrary to an economic theory, Chinese investments are spread more equitably across Africa. She thinks China will still play a significant role in supporting mining initiatives in Africa. The biggest energy importer in the world and a country with limited natural resources, China, she claims, is the reason. Africa will play a more significant role in China's international trade, especially in agriculture, energy, and resources. China is already a liquefied natural gas (LNG) investor and will undoubtedly purchase LNG from Africa. Energy and resources, infrastructure, and middle-class consumption, such as healthcare, entertainment, real estate development, and manufacturing, will continue to be the most crucial sectors for Chinese investment. Chinese investment has increased across all industries. China expands its markets to exploit Africa further. According to Tim Zajans, a research fellow at the Center for International and Comparative Politics at Stellenbosch University in South Africa, Chinese investments in Africa serve a variety of objectives. One of them has been getting access to raw materials required in China. Consider crude oil, different minerals, or so-called strategic resources, including cobalt, lithium, and rare earth, which all countries need to manufacture chips and batteries. Other Chinese investments on the African continent are more akin to market seeking because money is strategically used to expand existing Chinese product markets. For instance, in less than a decade, Chinese companies have acquired dominating market shares in Africa's electronics and IT marketplaces. For their part, loan debt investments in African infrastructure have increased demand for China's cement, steel, and construction sectors, which in the early 2010s had accumulated enormous surplus capabilities. As Africa's population increases quickly, Chinese investors have early recognized the potential and future demand on African markets. More than 10,000 Chinese businesses are operating across the African continent, and since 2005, Chinese investments have totaled more than $2 trillion, including $300 billion in ongoing assets. Africa has surpassed Asia as the continent with the most significant market for Chinese construction projects abroad. 90% of the Chinese businesses operating in the area are semi-privately held, casting doubt on the idea that China Incorporated is conducting a unified, state-coordinated investment drive into the room. Privately held Chinese businesses make up 80% of Africa's total investments. But it should be remembered that the concept of private firms is hazy due to China's integration of state and private ownership. Although state-owned enterprises typically have a larger size, especially in particular industries like energy and infrastructure, the sheer volume of private Chinese companies pursuing their own financial goals suggests that Chinese investment in Africa is a more market-driven phenomenon than is generally believed, says ZU. China offers a whole spectrum of skills, including finance, building, management, and frequent equity partnerships. China strengthened its involvement as a direct donor to the development of Africa's infrastructure in 2013, following the Belt and Road Initiative (BRI) launch, prioritizing power grids, special trade zones, ports, transit routes, and other prestigious projects. During this time, the infrastructure program remained primarily focused on physical infrastructure, only to shift its focus to digital sectors in 2015. Africa and other developing regions have and continue to be seen as future growth markets where Chinese firms can get a foothold by offering a price advantage to developed market competitors, who have frequently reduced their presence due to perceived compliance risks, says Mark Bolland, senior credit research analyst at Red Intelligence. I believe BRI has been less of a driver than China's business-driven Go-Out program from 1999 to 2000. The significant investment projects typically involve state-owned companies, but they are frequently followed by smaller private companies getting involved, typically in the restaurant and retail industries, and so on. These projects usually have the support of banks like China Exim Bank, China Development Bank, and ICBC. More than $160 billion has been loaned by China to state-owned businesses and debt-ridden African nations. Between 2000 and 2020, 1,188 loan pledges totaling $160 billion were signed by Chinese financiers with African governments and state-owned firms, primarily in transportation, power generation, mining, and telecommunications. Angola, Cameroon, Ethiopia, Kenya, Nigeria, and Zambia were the top loan receivers throughout those 20 years, and Ghana, South Africa, and Côte d'Ivoire were the most recent recipients. The largest borrowers in Africa to China are Angola, $42.6 billion, Ethiopia, $13.7 billion, Zambia, $9.8 billion, and Kenya, $9.2 billion. If one eliminated a bailout package for Angola in 2016, Bulletin claims that Chinese lending to Africa has been declining since 2013, which was also the year the BRI was unveiled. This has been fueled by a decline in commodity prices, remarkably the price of oil, which has diminished Beijing's perception of the necessity to ensure long-term access to these items. A few nations, like Cameroon, the Republic of the Congo, Ethiopia, and Zambia, are heavily indebted to Chinese policy banks, but generally speaking, multilateral and commercial lenders, who are good, are more heavily leveraged. Among the first African nations to receive sizable loans from China in agreements to ensure oil and mineral supplies were Angola, the DRC, and Sudan. Although China also imports a lot of minerals from Western mining businesses working in Africa, notably Ivanhoe Minerals, a Canadian mining company, in the DRC, the Chinese investment approaches toward more equity involvement, which is expected to continue. In addition to a high level of economic involvement through trade, loans, aid, and investment, Ethiopia and South Africa share a distinct strategic stance toward China. For instance, both nations have implemented unique China-related projects based on their national economic growth objectives, and they have also solidified significant ties with Beijing and the Chinese provinces. Zambia and Angola's interactions with China have been mainly limited to those two countries. In exchange for Chinese finance and the building of significant infrastructure projects in Angola, the government has provided oil to China. However, market-driven private investment by Chinese enterprises has been somewhat constrained compared to other African nations. Only 70 to 75% of Chinese businesses operating in Angola are private. Chinese businesses are manufacturing goods in Africa for Africa while making significant profits for China. China's GDP per person reached $11,000 in 2020, firmly placing the nation in the upper echelon of high middle-income countries. Therefore, the labor cost efficiency required for moderate to low-end global supply chains is no longer present. In contrast, the GDP per person in sub-Saharan Africa was $1,596 in 2019. Due to China's comparatively high labor and logistics costs, it is far more enticing for a Chinese corporation to produce in Africa for Africa. According to Bulletin, Africa is still a major source for the import of copper, coltan, and other minerals essential for China's industrial output. The main goal of Mozambique's LNG development is to supply Asian markets like China, Japan, and Singapore. Over the medium term, it is expected that the predominant pattern of importing raw materials like minerals and oil from Africa and exporting low-cost consumer goods will continue. However, given that wages in China are continuing to rise, there are initiatives to increase agricultural exports from Africa to China, with a financial support package approved at the Forum on China-Africa Cooperation in 2018. As well as Chinese investments in lower value-added manufacturing in Africa, with a focus on the African market. Zajance asserts, Africa's extractive industries will continue to be significant for China, particularly in light of the escalating geo-economic battle for access to critical resources like cobalt and lithium. At the same time, we will continue to see investments in agriculture as Beijing has committed to helping African governments increase their nation's agricultural export capacities. Another industry where Chinese companies will look to gain a competitive advantage over their more expensive Western rivals is e-mobility. China will continue to focus on other industries, like IT and digital infrastructure, to promote the usage of Chinese products and services throughout the continent. Before the COVID-19 outbreak, Chinese investment expanded in the African tourism sector. As China abandons its zero-COVID strategy and relaxes travel restrictions, we may expect to see FDI in tourism and hospitality across Africa pick up again soon. The viability of an unprofitable East Africa railway project connecting Kenya's port of Mombasa with Uganda, Rwanda, and South Sudan has recently been questioned due to a slowdown in Chinese finance for BRI projects. Uganda terminated its $2.3 billion agreement with China Harbour Engineering Company to construct a 273 km rail line from the capital city of Kampala to the Kenyan border town of Malaba in January 2023 following 8 years of Chinese finance delays. The Export-Import Bank of China, which had previously responded instantly to Kampala's requests, allegedly took nearly 2 years to react to Uganda's most recent request for funding, according to Ugandan authorities. About 10 years ago, Kenya, Uganda, Rwanda, and South Sudan agreed upon a high-speed rail system between Mombasa and the South Sudanese capital Juba via Malaba, Kampala, and Kigali, for constructing the Central Rift Valley Railway's first phase, which runs from Mombasa to Naivasha. Kenya got $5 billion at a high interest rate from China Exim Bank. This phase was finished in 2017. Plans to extend the line to Malaba, near the Ugandan border, are believed to have fallen through due to claims that China was engaging in debt trap diplomacy in Africa. Beijing expressed concerns in 2018 about the extension's financial viability and requested a new feasibility study before releasing financing. Future trends indicate that China's economic impact in Africa will only decline. China has looked to the continent for many of the natural and energy resources it lacks over the past 20 years. However, China will not significantly increase its investment in companies established in Africa that cater to the continent's rapidly expanding markets throughout the following 10 years.